Hi, this is Stacey Hyde, and we're back with another episode of Better Financial Health in 15 minutes or less. And today what I'd like to talk about is something you may have seen on the news or you may have not. You may have just, if you've looked at your retirement account balances, you may have noticed that some of your funds have gone up a lot. Some of them are doing okay, but some of them are doing great. And part of the reason for that is this is what's known as the market's been up, but it's been really concentrated on 6 or 7 technology stocks, which has kind of been a popular refrain over the past couple of years. And so what that means is that if your mutual fund didn't invest in those 6 or 7 stocks, you may be up, but you're not up the 20 or 30% that a fund that had a large portion of their assets invested in those funds had. Whereas the broad market S&P 500 is up about 13% depending on the day you look at it. I'm recording this toward the end of June. But if you had a value fund that didn't own Nvidia, Google, those types of things, you're not going to be up as much. So is that something you should be worried about? Not really. I mean, assuming that your investments are pretty broad, if you're not keeping up with the best performer in one particular year, that's really nothing to be concerned about, because a lot of times those big performers will come back down to earth. This actually kind of reminds me a little bit of what went on during the pandemic when GameStop was really excelling and it was distorting the small company indexes. And so, if you look at what does that mean, the current price, when you look at it in the standpoint of what is its price to earnings multiple, the future earnings that are going to have to be earned by the company to justify that level of stock price, it kind of makes a person go, not so sure that that's really going to work. So you want to be careful about coming in late to the party. It's a bit like musical chairs. When the music stops, you want to make sure that you have a secure place to sit. And that's why keeping your investments broad and spread out, while yes, you may miss out on this temporary rise, you also miss out on if it winds up course correcting and kind of leveling out. You also smooth your ride, which for most people, that allows them to stay invested through the good times and bad times. So that's something I do want to stress. Investing in particular can really lead to FOMO, fear of missing out. Hey, I didn't own Nvidia, so I've got to find the next AI, artificial intelligence stock, and try to find what's there. You can do that if you have a lot of time and that's where you enjoy spending your time. That's great, but I would really encourage you to stay broadly invested. I think that investments globally actually have a lot of upward momentum as the dollar depreciates. It makes it easier for US dollar-based investors to earn really good returns on their international and emerging markets investments, because as those foreign dollars are converted back into dollars, it gives you more dollars per earnings. And so I think that that's going to help us going forward. Also, interest rates being, in the 4 to 5, 6% arena, and people even able to pretty consistently to get over 4% on their cash if they don't keep it in the biggest banks, maybe use an online savings account that we've talked about before, you're able to really kind of lift your whole portfolio and have a steady, good projected return. So that would be my advice to you, is to not get caught up in just those few stocks, to really look at, what's the S&P 500 index, what's the Russell 1000, which is a value index, and then the Russell 1000 growth index. And you can see the growth index has certainly outpaced value this year. But when we were during rocky times, that value index really held up better than the growth. And that's why I think it's important that you own both and know that sometimes growth is going to outperform, sometimes value is going to outperform, and sometimes smaller companies are going to outperform. We just don't know. And so what we would encourage you to do is sort of have exposure to all of those, so you'll never be the worst performer, you'll never be the best, but you'll be able to participate meaningfully in what the markets give you. It's not exciting, but sometimes the best way to stay invested is to be a little bit boring and have a nice emergency fund. So thanks for tuning in. This has been another episode of Better Financial Health in 15 minutes or less.